Good afternoon, everyone. Futures Brizio here, 5 p.m., well, almost 5 p.m. on Tuesday, December 10th, 2024. Hope everybody's having a great week so far and a good day. Um, as always, before we get going, make sure you smash the like button, subscribe to the channel, and ring that bell notification so you get notified when I make new content. And of course, any questions, comments, please leave them down below. Happy to respond, reply, etc., as long as they're relevant. Um, I got a couple of just spam comments the other day, which with kind of nonsensical questions, which I just deleted. I'm not even going to entertain that, so I just deleted them. So if that's you leaving them, don't bother because they're just going to be deleted. So, what I wanted to talk about today. I know I've been doing a lot of videos on trading on the higher time frames, but I still get questions about trading on short time frames. It's not something I do regularly, but I did want to show you a way that and this is only in futures, by the way. I would not do this in forex. Excuse me. And it's very easy to explain why. So this is only in futures, and basically it's trading on. Excuse me, on a short time frame. So these can be scalps or day trades. Anywhere from a 5 to 10 minute chart is my preferred area for this. And it's basically trading small price moves, whether they've been continuations or reversals, using just price action and volume. Okay. And that's it. Okay. And so the reason why I don't do this on Forex, any of you that trade Forex probably know what I'm going to say, but it's because Forex is not a central exchange traded market, so it's very decentralized. So in other words, this is crude oil, right? So crude oil is traded on a centralized exchange. So everybody that's trading WTI crude January 2025 contract is trading on the same exchange, sees the same price data, same pricing, everything. And so the volume that you're seeing is the volume everybody else is seeing too, in terms of, if you're looking at the same contract, month, year, whether you're trading micros, minis, regular, whatever, you're seeing the same thing everybody else is seeing, okay? So it's more of an even playing field in that respect. If you're trading on Forex, spot Forex, which is 99.9% of the Forex market, the volume, if you put a volume indicator on your chart, the only volume that you're actually seeing is the volume being reported from that particular broker, okay? So you're not seeing volume across the entire market. And so in that respect, it can be very misleading because obviously it's going to vary from one broker to the next. And you're basically seeing mostly just retail volume and that's all. And so I don't recommend using volume indicators on Forex. I know some people probably would disagree with me, but look, it's a simple matter that it is a decentralized exchange and you're not seeing the whole picture. So certainly there's other ways to trade Forex, as I've made videos on and everybody knows, but this is not a way I would do it, okay? That's just me. So, all right, so basically what I have here is just the regular volume indicator that's available in any platform. Now, I changed the colors here just to all blue, and you can pick obviously whatever colors. Now, it defaults to red and green. So up volume would be a green bar and down volume would be a red bar. I don't really care about that because I'm just looking for divergences and, to see volumes either coincide with a move, continuation, or suggest a reversal. And I don't really care what color the bar is. So just to make it simple on myself and not second judge what I'm looking at, I just made them all blue in this case. Okay, so I'm just going to show you a couple of examples, and basically I'm just using the volume to tell me whether I think that the market is going to continue in the direction that it's been going, or whether it's possibly going to reverse. Now I don't mean a full trend reversal. It could just be a correction, but on a 5-minute time frame, a trend could just be a correction from a higher time frame. Okay. So obviously, if you take these positions in direction of the larger trend, like so if you go up to the hourly chart, 4-hour chart, whatever higher time frame you want to use, and the setup is in the direction of that trend, well, that's even better. But because these are not intended to be trades that you're going to hold on to a long time, they don't necessarily have to be. You can just take advantage of profit taking later in the session, or just a slowdown in orders, or like I said, a lot of times just profit taking after a strong move in one direction. The volume kind of runs down and starts going the other way. And we actually have an example of both of those in this picture here, which is crude oil. So I'm just going to review this. So first of all, this line here represents 9:30 a.m. New York time, which is the beginning of the future session in North America. Now, of course, these markets trade all night, and crude oil actually really starts moving more earlier in the session. Often, this is 3, so this is around 6 a.m. And so you can see this uptrend was already underway, which can be valuable information. Obviously, I'm not trading it this early. I probably wouldn't start trading until about this time, which is 8:30 a.m. For this market, and maybe for gold. But for the NASDAQ, I would not trade it like this until at least the New York Open at 9:30. But for commodities like crude oil and gold, certainly these can be looked at earlier than 9:30. But primarily I trade after 9:30 because I can find setups then, and I can find potential reversal setups or pullback setups later in the session, as I did today. So let's just talk about from here. So this is when the market opened. Now you can see again coming into this, we had strong upward price momentum, and just for this, well, I guess I can leave it. I was going to take this indicator off now that you know what this is. In fact, yeah, let me just take that indicator off. Don't really need to see that now. Okay. So coming into the New York Open, we had strong price action. We had this bullish price action, and we had this pullback. And you can see we had some pretty bearish price action right here. But if you look over here at the volume during that time, right? Yes, price was going down. Okay, price was going down. Okay, but the volume was also going down during this corrective time. Okay, so it's just suggesting that really this down move is probably just a correction, and price is probably going to go back up again. Okay, now one thing you have to remember is you kind of have to be willing to take these trades potentially a little bit early, but again, on a 5-minute time frame, it's going to be pretty low risk because your stop losses are going to be relatively small. So you can't really wait necessarily for like this big giant engulfing candle because you've already missed a lot of the move. These are not intended to be trades you're going to hang on to for a long time. And so this is, I probably would have looked to enter probably somewhere in here. But basically we had price move down, and we had, at the same time, we had decreasing volume. Okay. Now, but you notice what happened right here, which is why I said I would get into this. If you look at this bar right here, okay, you had this bar right here. Notice as the volume is dropping, we had this spike right here, and that happened to be on a blue candle. Now it did end up closing back about in the middle of the range, but still it was a volume spike. And so that means the buyers are still active in here. So this actually would have been and was my entry. As you can see, this blue arrow, that was my entry. As soon as I saw that candle close, I jumped in. I put my stop. I don't remember. I think I had it right here. Maybe I put it down. I don't remember where my stop was. And then I just waited. And you can see price danced around for about 15 minutes or so. And then all of a sudden, boom, we had strong price action up. Okay, and so then why did I get out of this trade? And you can see I got out at a pretty good spot here. Well, as price went up and made a new high right in here, you can see now we started to get divergence in the uptrend. Okay, So we started to get this price divergence where the price went up and made a new high, but yet the volume was continuing to sink. And this, so we had this bull candle right here, and you can notice at the time this high was put in, all right, we put in a new high, but the volume was lower versus the last high over here, okay? And then we continue to move on. We had two bear candles. Now, so again, I could have held through this because yes, we had two bear candles, but again, notice the volume dropping as we painted these two bear candles. So then price did try to go up again and made another new high, not really much, very, very small, maybe this may be like 1 point higher here. And you notice once it made this high right here, the volume dropped way down. So there was no increase in the buying volume, okay? We had less buying volume on this bullish candle, and then when it got up here, made a new high, there was even less volume. So that started to tell me that the market potentially was running out of steam at that point, okay? And then we put in this bearish candle right here. That wasn't enough for me to enter, okay? But then right here, okay, this is not a huge volume bar, but it was higher than these previous few bars. So there's a lot of subjectiveness in this, but again, it's a low risk trade because I did take this trade. I put my stop just above this swing, and I just let it go because I felt like when I saw this volume bar right here, which is higher than these previous ones, which included bullish candles, I said, okay, I think we're going to at least see a temporary pullback in this market. And I let it go, and sure enough, that's what happened. Now, I did leave a little bit of this on the table. I had my stop loss because I went out. I put my stop loss back at this previous resistance, now support. I mean, I could have put it down here. This is ultimately where it went to, was basically back to this support demand area down here. So it did go a little bit low. I left a little bit on the table for sure. Okay, and then after that, the market, it got to be later in the day, and you can see things just started going sideways. So by this time, I really wasn't interested in taking another trade anyway, so I was pretty much done. But basically, it's just using volume candles to, look at what the trend has done coming to the charts, and then playing the divergences or the continuation, the divergence of the candles, which could tell you, versus volume could tell you that maybe you're going to have a reversal, maybe you're going to have a continuation, and using a little bit of subjectiveness too. You do have to be patient, wait for candles to close and wait for the volume bar to close because during live action these things are going to be dancing. Now the volume bars won't get shorter. If a bar goes up, at some point, it's never going to go back down. You're not going to have volume go up and then back down again. It's going to continue to go up. But the question is, does it, where does it end up closing? So you do have to wait for the candle to close. But you don't, obviously the volume bar is not going to go backwards, right? So once it peaks at some point, it's going to close at least at that height, if not higher. Okay. Now, in here, you also could have used just simple market structure, too, in addition to using the candles, so the volume. So as price went up here, there is a little structure level right here. You had this pullback that led to this high. You could have entered, anywhere over here. Now, I got in sooner, and because that was based on the volume, not just the price structure. But once I saw price break this level, I was pretty confident that this was going to go lower, okay? And again, it's just using volume and a little bit of visual skill and just being a little bit patient. Now, you can do this on a higher time frame. I wouldn't go much for these type of trades. I wouldn't go more than about a 10-minute chart because then you start to lose some of the detail. But I wouldn't go shorter than 5 minutes. If you go down to a 1 minute, there's going to be too much noise. Even on a 5 minute, it can be noisy. But I feel like for these type of scalping positions, that the 5 minutes a good place to be. But you could use a 10-minute chart too. I've taken trades before doing this off of a 10-minute chart, and that does clean it up a little bit. It's not as noisy, but you could potentially lose some detail and lose a good entry point because obviously you're only getting one volume bar every 10 minutes instead of two volume bars inside of that 10-minute period. Okay. So again, 5 to 10 minute time range for this. And you should really back test this too. And it's very easy to back test this. I mean, you can go back on your charts, start, mark off, the beginning of the trading session, wherever you normally come to the charts, and just start looking. Put the volume indicator on your chart. It's great. It will show you what happened at that time and at that price, and you can really get a feel for it. And you also got to not be willing to trade a lot of assets, because there's no way you're going to be able to analyze more than 2 to 3 markets. And so you can see I only have NASDAQ, gold, and crude oil here. These are the full crude and gold contracts as opposed to the micro ones. And I'm just using these just to see if the volume matches the on the full versus the micros, and they pretty much do. Occasionally there are some differences, but that's it. But it's really just those 3 markets. Okay, so that's crude oil. So 2 trades there today in opposite directions. Obviously the trend was up, but again, this pullback or correction or whatever, reversal, this started at 1700. So this was 2.5 hours after the market opened. So this was around noontime New York time today. And that's about right. I mean, by then in the afternoon, things do start to potentially back off, whether it's just large traders exiting their positions for the day, just taking profit and just cashing in for the day. And then it just becomes kind of a snowball downhill here until later in the day when things, just completely quiet down and start going sideways. So, okay, and now let's jump over to NASDAQ. And I took this trade on NASDAQ, and this is the 5-minute chart. Again, the market open was up here. And because it opened on the highs here, I actually was looking to play a reversal today, and I got into this way late. And I'm not really sure why, but I'm still kind of learning this myself. Obviously, there was a clear structure break, so I could have taken this trade probably starting right in here, which would have been a little closer to where I did enter. But anyways, let's take a look at this. And as we went up, so we put in this low here. Okay, we had this big reversal candle, and obviously the volume was pretty high, although it didn't take out these previous highs on these 2 highs right here. Okay, but we did have a little bit of divergence on this candle right here for this little doji, and then we came in, we put in this big bullish engulfing candle, and the volume was a little higher, but it was still lower than this last bullish candle. So I certainly didn't feel like this was an entry point, because we didn't get a really big volume spike on this this bearish candle, and indeed price did go up and make a new high. Now once we came up here and we put in these highs, we did put in, you can see the divergence, we put in these highs, and not only did the candle bodies just get really small and wicks, but look at the volume on these last 3 candles going up. The volume sunk all the way down to, right in here. Okay, the volume sunk all the way down here, so that we had price divergence. Okay, where the volume was not keeping up with these and was actually sinking. Now again, on a pullback, if you see this, if price pulls back and you see volume decreasing, that's probably just a correction, and the continuation probably will happen. But on the continuation of price, if the volume doesn't keep up, at least stay level and constant, doesn't necessarily have to spike higher, but at least has to be keeping up with the previous volume, then that's a red signal that price could reverse. And then what happened was, we came over here, okay, and we had this bearish candle, which did have a little bit more volume than the blue candle, than the previous high. Still didn't feel like that's enough. And then we had this next bearish candle, the volume was even lower, okay, and then we had, so again, I still didn't feel like that was enough. And then we had a blue candle with a higher volume, okay, and so that actually would probably lead you to believe that this thing was going higher. And this is what I mean, like, it's not going to always work. If I had gone long here, I would have obviously been stopped out, but that's okay. And it wasn't until we got to here where all of a sudden we see volume after it bottomed out right here on these red candles. Now all of a sudden we start to see spike in bearish volume, and we took out market structure. We took out this little structure right here. Okay, so on this candle right here, we did get this volume spike that happened right, whoops, trying to grab this. My computer's running really slow. Right there. Okay, we had that volume spike on this bear candle, and then price went down. Okay, all right, and then when I saw this over here, when I actually entered, it was because we had this pullback. So it was kind of the opposite here, where we had this bearish pullback and then price went up. Right here, you can see what happened. We had this bullish pullback, okay, but look at the volume. So price, let me just put a trend line on these. We had price going up right here, and at the same time volume was dropping. Okay, volume was dropping. Okay, and so that led me to say, you know what, we took out structure, we had a pullback, volume is continuing to drop. We didn't have really any follow through on these bullish candles going back up, especially on this one, which broke these highs. Okay, this candle broke these highs right here, grabbed some liquidity, but yet we had a very low volume here. And so that was my telltale sign. And then price broke down. I eventually took this trade right here, and I sold it out, closed it out down here. Okay, and then we, that turned out to be pretty good. It did go down a couple more points, but nothing huge. And then, we basically just washed out the rest of the day. So, all right, so that's basically how you do it. And you can see, again, just as I'm describing this, that it does take some effort here to watch these. This is part of the problem with trading on 5-minute time frames, short time frames. You have to be very tuned into what the market's doing, and you don't know when those opportunities are going to come. Sometimes they're going to come right at the open. Sometimes they're going to come, 1, 2, 3 hours after the market is open. And so you just have to be ready and be willing to, track these things and follow them. And, if you're not watching, you're going to miss them. I mean, that's just the bottom line. And the other thing is you have to be able to determine, where a good point is to enter and exit these trades. So that at that point, I would jump out to, higher time frames and look for, previous support and resistance areas, supply and demand areas, and, look for something, where you could target a particular zone where you might want to, exit the trade. So, and then, like I said, your stop losses should be pretty tight. If you get in at these, don't chase the market. If you miss the entry, just let it go. Honestly, because you're dealing with such small areas here that if you chase it, you're going to have a terrible risk to reward ratio, and it's just not worth it. Just let it go and, catch the next one, or just, trade it the next day. So, like I said, I missed the whole first part of this, but there was a nice pullback, so I did catch the next one. I did catch the continuation. I left half of it on the table. I'm kind of bummed about that, but oh well. So that's really the strategy, guys. So for those of you that want to trade on 5-minute time frames, short time frames, I really suggest that you use volume in addition to the candles, because the volume is going to tell you what is going on at that moment. So this is time-based volume. Okay, there are also things like volume profile, which I have made videos on in the past. I don't use it. I really don't like them, so I don't use them anymore. But a volume profile is volume at price. This is obviously volume by time on the bottom here. And this is a standard indicator. Again, I just changed it to all the same color because I don't really care whether it's a red bar or green bar. I'm just looking at the size of the bar and whether there's divergence, whether it matches the volume that I'm seeing, matches the price action I'm seeing, or whether there's some kind of divergence where it just doesn't look like that move that, is happening is going to follow through. And like I said, you also, since these are these are micro contracts, if you want to bring up, like I said, for oil, I don't have the NASDAQ one up here right now, but for oil, and you can bring up oil and follow the action on oil on the higher time on the full contract. You may get a slightly different picture, okay, of the volume, but it's because these are the bigger contracts. There's going to be more overall volume in here and probably some bigger players in here versus the micros. And I can just point to an example right here on crude oil. So look at this big spike here on crude. Okay. Now, granted, if you waited for this, you really missed this move. But look at the size of this volume bar on this down. There's a lot of volume selling off on this thing. Okay. A lot of volume. Okay. And so, we had this push up on this up move here, and then price quickly reversed. Okay. On the micro contract, we look at that same spot. Here it is on the micro contract. Okay. The volume bar is also pretty big, but it's not doesn't stick out as much as the one on the full contract. But you can do either way. Now, I do want to point out that this may have fooled you, and this is done to stop people out and grab liquidity. We had this bullish bar right here, and we go down and we look at the volume bar on this. Now, it's not huge, but it is bigger than the last couple of ones right here. We had these three little small bars preceding it, and then we had this spike. And so you may have gone long right here only to have this thing, the very next bar, stop you out, okay, when this thing spiked down. And that's going to happen. And so that's what I'm saying. Like, this is not a perfect system. In the real world, you may have been stopped out of it. Now, I was already in this trade, and I wasn't watching this. I had my take profit set, and I walked away from it, which I'm glad about, because if I happened to be standing in front and watching my charts, I probably would have closed my trade right here, with about half the size of the profit that I did get, which wasn't huge, but it would have been a lot less had I been fooled by this. So that's why you have to just kind of let it play out, and you are going to see sometimes these liquidity volume spikes, where in this case they bought in order to sell. Okay. And so again, you can see that volume. That's this bar right here at the bottom next to this really tall one, and it was preceded by a lot of small ones. But the thing is these buying bars, this one and this one, these blue ones, had very, very, very little volume associated with them. So I feel like if these had some power behind them, we would have seen higher volume here, and then this pullback, and then to see this move up. But because these bars were, these bullish bars were preceded by very, very little volume. Again, I wasn't in the trade at that time. I mean, I was in the trade, but I wasn't looking to enter at that time. I was already in. In hindsight, I'd say, maybe I wouldn't have been fooled by this, only because these two previous bullish bars had such little volume attached to them. It just didn't make sense why we would see bullish bars here, a pullback, okay, low volume, very, very low volume bull, and then a pullback, and then this false move up if this wasn't a liquidity spike. And that turns out that's what it was. And on the full contract, you can see that too, right? Price went down here, right? Price came down. We had these two low volume bullish volume bars here associated with these bullish bars. And then, we had this pullback, and then price went. Okay. And if we look at, and it's the same thing, right? We had this false break after these really weak bull bars, and then the price went down. So again, it's not perfect. Now, if we look at that, and I haven't done that, but let's just do it now. Let's look at that on a 10-minute chart. Let's just zoom in a little bit here. So here it is on the 10-minute chart. And again, we had low volume. Then we had a little spike up on this doji candle. And then the next candle came back. Okay, closed higher technically. This close is higher than this close. You can just tell by looking at it. And an even lower volume bar. So again, no follow through. And this is what I mean saying that You can do this on a higher time frame, a little bit higher. This is a 10-minute chart, and it takes some of the noise out of here. So you may miss some trades, but using the 10-minute chart is definitely an alternative to kind of slow things down and give you a little bit more chance to react. So let me just say that again, right? So you had these 3 bullish bars right here. We had very low volume on the first one. The next one was a little bit higher, but look, there was no follow through. It closed back inside the range. And then the next one came, and that actually closed slightly higher, but the volume was even lower. So that's just telling me that there's no interest. Okay, and then the very next candle, we had price ran up. Obviously, at some point, this was a blue bar, and then it quickly reversed down and became a red bar. And as soon as we see that red bar start to form and this big volume spike with the big wick, then you go short. Okay, but again, that's why you don't want to pre-jump into this, because while this was live, we had this volume building. Now, I'd have to the one disadvantage of seeing this in hindsight, we don't know at what point this bar became this big. Did it become this big right up here, or when it started to sink lower? Okay, I'm thinking it probably spiked when it actually ran lower, because they ran it up. The volume bar probably came up, and then as soon as they started pushing it down again, it probably ran down even more, and then the volume bar got bigger. Okay, but that's why I told you got to wait for the candle to close, whether you're on the 5-minute or the 10-minute. But the disadvantage with this is if you're on the 10-minute, you wait for the candle to close, you obviously had a lot less profit potential on this because you would have had a little bit of a late entry. So that's the trade-off, kind of, going with these on a 10-minute chart versus a 5-minute. On the 10-minute chart, you're going to have a little bit cleaner entries and a little bit easier analysis, but you may be in late if they're just going to be short moves, and that's it. Of course, this was also later in the day too, so you can see it went down for a half an hour, and then that was it. Price did nothing the rest of the day. Okay, so this was like the last little hurrah for the day. Closed at the lows here, and then that was it. Price just did nothing. You can see the volume just dried up the rest of the day, and I wouldn't have been looking for trades at that time anyway. So, all right, so that's volume trading. Scalping, day trading on a 5 to 10-minute chart, and you can see it uses nothing but price action, your candlesticks and your volume indicator, and you can leave the colors on there if you want. Do whatever you want with the colors. It really doesn't matter. And just be patient with it. Wait for the candles to close. And just, start observing it. Go back and look at previous days during the hours you trade and notice what the volume bars do during pullbacks versus reversals. What happens during a continuation versus a pullback or a reversal. Look for, divergences. And again, it's not perfect. It's not always going to make sense, because the market's organic and that's just the way it is. But you definitely can do it if this is the type of short-term trading you want to do. It's not going to really help you on long time frames because you're only going to see volume over a very large period. And there might be some potential help in there for like swing trading using divergence, volume divergence. But I really think, if you're going to use volume, the main point with volume to me is really in scalping and day trading, not really so much in swing trading. I think it's less important for swing trading. So, but again, you might have a different opinion on that. So, all right, so I'm going to leave it there, guys. Hope you have a great night. And again, smash that like button, subscribe to the channel, leave questions and comments down below. I hope you have a good night, and we'll talk to you soon.